All right, testing. 1, 2, 3, testing. 1, 2, 3. The rain in Spain falls mainly on the plains. The ants in France stay mainly in your pants. Good morning, how are you doing? Comment allez-vous? Jambo? Ni hao ma? Ohio? Good morning. Welcome to Forex.Today, the YouTube community of almost 19,000 foreign exchange traders. So live from Atlanta, Georgia, America, and seen around the world, Forex.Today. Let's get on with it. Let's go. Warning, warning, warning. Forex trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, my name is Wayne. Am I off center or is the camera moved? This way, that way? I don't know. Whatever. Hey, my name is Wayne. I'm a currency trader. Been doing this a very long time. And I am here to teach you how to plan your trades in advance, technically and fundamentally. Okay, with the overriding goal of maybe consistency, maybe profitability, or ideally, when you combine the consistency and profitability, what you get is a good risk-adjusted return. Yeah, Sharpe ratio. Cool, right? Ultimately, that's what you want. Once you're profitable, you want to be compensated for the risk that you're taking. And so anyways, planning ahead just might provide that consistency, huh? So anyways, ask questions, get involved. I'll do my best to address your technical analysis and fundamental analysis and trader psychology and all these things that are going on. Hey, did you catch the Chinese data over the weekend? Wait, am I supposed to pay attention to that? Or are you just thinking about non-farm payrolls last week? Are you watching the bond market? These are all good questions. So we will try to get through them throughout the week. Also, on Wednesday, I will be flying to New York City because that's what bosses do. So if you want to meet up on Friday, I will be hosting a small group of traders at the Harvard Club up on the roof, on the rooftop deck. So there'll be, I'll buy some food. You buy your own cocktail. I think that makes sense, right? And then maybe we'll go out and paint the town red. Okay, tear up the city. So anyways, if you're going to be in New York on Friday, get a hold of me. I'll send out an email. Don't you worry about it. But I will be doing my live streams on the road. Okay, as I always do. So thank you for being here. Thank you for being part of the community. Thank you for your positive energy. Thank you for your tenacity to stay with this thing we call Forex. And trust me, I know you're making sacrifices. I know this is difficult. I know it's straining. I know it takes a long time, but I tell you it's worth it. Okay? I reassure you that it's worth the blood, sweat, tears for years. It's worth it. Once you get this put together, trust me, it's worth it. I'd also like to thank TradersWay.com for being part of our community as well. They are the broker that has earned my loyalty and respect. They've proven to me that they actually enter trades into the interbanking system. And they don't trade against me. They don't bebook me. I like that. Hey, I like that. Not through words or something they put on the website or a Facebook post. No, but actually by their actions when the market was under severe duress. What actually occurred was proof. So I'm like, wow, this is really cool. So anyways, Traders Way has earned my loyalty and respect. If you go to tradersway.com, open up a demo account, get maybe an MT4 and MT5 account. You can have a fixed spread. You can have a variable spread. You can have an ECN account if you prefer that. Hard dollars versus soft dollars. Pick the account you want. The cool thing is, hopefully over a period of time, they earn your trust, your loyalty, and respect as well. And then when you're ready to trade real money, you're like, hey, I already got that execution partner. Okay. It's a big decision. It's probably, I don't know if it's the most important decision, but it's a big decision. Yeah, maybe, yeah, it's up there. So you know what? Develop that relationship now. Okay. I'm just lighting the candles. I'm setting the table. I'm dimming the lights. But ultimately, you need to make the first move and develop the relationship. So that's by visiting tradersway.com. Coolio. So here we are, euro dollar. What do we know? Well, let me get my EpiPen. Cool, there it is. All right, what do we know? Here's the top. And based on technical analysis, what we've already covered, I don't know, 5 times already. The target is 117.28. So there's going to be a lot of people that go, oh my God, what's going on? The euro dollar, blah, blah, blah. And you're like, yeah, well, you know what? There's the target, 117.28. So, you know, we opened with that still in mind. Now, does it actually have to go down there? No, but I would like it to. That's what analysis is. So what you're trying to say is, you know, if you're connecting these dots and you're a bear is going to sell it off the 21. Do they have to? No. Market can do whatever it wants. But that's what's in play now. See, I'm a bull on euro dollar. Okay? I'm a bull. But that's not an opportunity for me yet. So let it fall. I don't really care. Now, if it bounces off this level, then I can kind of play it like this as support. We'll call it 1750 being a midpoint psych level. And I say, okay, cool. But then I got a lot of time, like, right? I got ambition, baby. But, you know, I don't need to be the first mover. So I got a lot of time here. Okay? So right now, though, this has still got some momentum, and I think the bears can do it for sure. Great. And then I'll pick it up down here. I think it will come down to 17. I think that's the play here. 1750 down to 17. And then maybe I start building my long-term position. But remember, my long-term positions are going to be held up by the Fed meeting in September and the market's sort of preparation for that. Hey, Mr. Detroit's in the house with his wheatgrass. How's the wheatgrass this morning, Mickey? I haven't had wheatgrass in so long. It's just funny. I think it was Jamba Juice used to sell that. Hey, man, I bet you it's ripper good for you, though. All right. So anyways, yeah, so let's zip over that. I mean, there's so much we could be covering today. We can do... There's so much to do. There's so much going on. It's such an interesting time to be a trader. Yeah, very green. Oh, yeah. Gee whiz, I need my glasses more and more often now. I can barely see this. This is crazy. But I hate glasses. They're always dirty. And now I'm finding out they're always dirty because they're scratched. I'm like, what? Wait? They don't have like bulletproof lenses yet? They probably love the fact that glasses scratch easy. They're like, yeah, we make more money. So anyways. It's like $3,000 or something for Tom Ford glasses made out of plastic. You're like, dude, seriously? What a ripoff. All right. What do I want to do? Oh, yeah, I want to go this week, next week, tomorrow. No, I want to go. Wait. Maybe it's on here. No, I want to do yesterday. Well, let me do yesterday. What? I can do forward, but I can't do back? I think I can do that. Oh, I see. Begin date. Well, we'll begin 6 and go to 8. Will it do that? Cool. Here we go. All right. Cool. All right. CPI 1. Okay. Check it out, though. It was 1.1. Not a lot of inflation. Okay. Exports. No data there, huh? We'll have to Google that. Wonder why they didn't post that. This will be July 2021. Okay. 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 Is this right? Let me double check. Exports rose 19% year over year. Okay. A little less than expected. Let's look out 5 years. That's not bad though, huh? It's less than expected. But doesn't it seem like we're, oops, delete. Doesn't it seem like we're kind of looking at a distribution like that? Well, actually, technically, if I'm going to do it like a distribution, it's probably more like this. Okay. Can you calculate the standard deviation? Yeah, it probably looks like this. Okay. Anyways, what we're also looking at is relative not to COVID-19, okay, but other years, okay? So this is pretty good because remember, they're exporting products, aka making money. But also we're trying to track the flow of money. Exports grew from the United States by 13.4. Euro's finally kicking in. Thank you, EU. Well, maybe the growth is higher because remember, relative to a previous number. And the previous number was horrible because Europe is poor. Do you understand? Do you remember that Jean-Claude Trichet was the last ECB president or council member to raise interest rates? Jean-Claude Trichet. And 2 weeks after raising, he cut. He goes blindsided. Jean-Claude Trichet was the last at the ECB to raise interest rates. When will the ECB ever raise interest rates ever again? You have to remember, you raise interest rates when everybody's rich. Europe may go another 10 years, maybe 20 years before raising interest rates, right? So anyways, so exports to the Eurozone or imports by the Eurozone are up, but probably off of a really bad number. Okay? Now, Asian countries. I forget the members of the Asian countries, but have you guys been tracking PMI? Global PMI? Vietnam, Indonesia, I think, Thailand. They all have, and there's more obviously, but I'm just picking some countries here. They all have PMIs that are less than 50. They're actually contracting. Their economies are getting smaller. Amazing, right? So we got to pay attention to that because we're macroeconomists, right? And anyways, increases to Australia by 10%. That's pretty good because that's probably more consistent than here. And so that's good. So Australia is importing. Now, we might also want to look at exports because we want to, Australian exports or Chinese imports from Australia. But that would be a different number. But what I'm getting at is this means what? Well, if there's an increase of sending stuff to the United States, then that stuff, 13.4% more than before, is priced in dollars. Therefore, the United States is exporting dollars and importing stuff, which would weaken the USD. Oh, wait, what? Yeah. This is why we track this kind of stuff. Okay. Another thing I want to point out that I've been thinking about over the weekend, okay, has to do with a scenario that looks like this. You know what? Let me close this window. Hang on. Okay. All right. We'll go dollars quantity. Okay. Demand curve. Supply curve. Equilibrium. Okay, and now I have to label it. Okay, supply 1, demand 1. Okay, quantity equilibrium, price equilibrium. All right, cool. So there's our chart. So what can the Fed do about inflation? If they're worried about inflation, what could the Fed do? Remember, inflation means prices are too high. I want you to think about this. Because we're trying to figure out what the Fed is doing now, but what will the Fed do in the future? And I hear a lot of talk about inflation, inflation, inflation. Okay? Well, to get prices down, the Fed could lower demand by increasing interest rates, making it more expensive to borrow money, for example. Because now we're talking about money supply. Okay? And you'll see if the Fed does that, okay, we get a fall in price. But where does our inflation come from? Some of our inflation is because the stock market is going up and the price of houses are going to go up. Both of which are influenced by low interest rates. So if the Fed raises interest rates, that may address some of that issue. But what's the other problem in our economy right now? Well, it has nothing to do with demand. So when you read or hear, oops, dang it, I didn't mean to do that. Good. When you read or hear about the Fed, I want you to understand that the only thing the Fed could do is shift the demand curve. So when demand was low and prices were low and quantity was low, what they did is they increased demand by putting free money into the market. And the government did it too by just giving us money. And the idea was demand would increase. You'd buy a TV now because you got free money from the government. Okay? And therefore you increase the demand for TVs, and then eventually prices kick in, and now you have inflation. And then when inflation kicks in, then they remove the free money, raise interest rates, and then you move demand this way, and you lower prices. So the Fed, through demand, can increase prices, but then just doing the opposite, they could lower prices. And by prices, I mean inflation. What's the problem now, though? Where are the high prices coming from? Is it the fact that too many people are buying TVs? What's the problem? Why are prices high in the United States? Lack of productivity, supply. And when supply falls, okay, when supply falls, what happens? So quantity is less than the equilibrium. So you can see here, quantity 2 is down here. It's less than quantity equilibrium. Sorry, I'm trying to get this straight, but okay. And you can see because there's not enough to meet demand, prices have gone up. Well, what is the Fed supposed to do about that? What can the Fed do about that? Okay? Well, because it's a supply side issue and not a demand side issue, there's enough demand for most things, that eventually supply will catch back up and will move back to equilibrium. That's what is meant by transitory, just to put things into context. But there's so much discussion now about the Fed, the taper, and they have to raise interest rates because of high prices. Does that make sense? Think of it. Let me say it again. You read that the Fed has to raise interest rates as soon as possible to fix inflation. Is that analysis correct? If the Fed raises interest rates, will Ford get enough chips to make a car? No. If the Fed raises interest rates, will you be able to buy a gaming GPU? No. If the Fed raises interest rates, will I get my fridge that I paid for 6 months ago from KitchenAid? No. So why should the Fed raise interest rates? This is a supply issue, not necessarily a demand issue. Now, there's going to be some, noise inside the demand, but I'm basically fixing it here. There's low demand for loans right now because everybody has cash. What is there a shortage of in the United States? Everything. But you have to understand, a lot of this had to do with COVID, and a lot of it, and that's that. So when you hear the Fed has to raise interest rates, by the way, let me ask you, have you been running into this in the media, whether it's TV, YouTube, newspapers, websites, blogs, tweets, whatever? Are you running into the message that the Fed has to raise interest rates to address inflation? Yes or no? Okay? That in my humble opinion, they don't understand. And you should really question their opinion. Okay? Yes, raising interest rates will lower prices by changing demand. Now, you might argue the double shift. Well, if you make fridges so expensive nobody buys a KitchenAid, think of that. Think of this, guys. If the Fed jacks up interest rates to kill demand, while there's a supply shortage, what happens? Well, first of all, it's a double shift and it's indeterminate. But what happens is now there's no fridges because nobody can afford them. Well, who the heck wants that? Would that fulfill the Fed's mandate to say, well, there's a lack of fridges, but we'll make it so that no one will demand the fridges and therefore we'll have a new equilibrium? Not very many people want a fridge or can afford a fridge. Therefore, because KitchenAid isn't making very many fridges, well, then we got equilibrium. Yeah, or Kevin's completely right. Or you just buy a used fridge. And that's what we're seeing in the car market. There's no chips, so Ford can't make a car. So the few cars that are on the Ford dealership lots, they're certainly not on super sale. So people are like, well, I don't want to pay 30 grand for a Ford, so maybe I'll just buy a used Ford for now. But used Fords are up 50%. Okay? The cheapest golf cart in my city is $9,000 for a piece of junk. Pretty amazing. That golf cart 2 years ago would have been $5 grand. Now they're $9. Okay? Amazing, right? So anyways, you don't want to kill demand ever. Okay? There's just a lot of cash in this world, but there's not enough supply. So once supply catches up, those prices will come down. And then what will happen is prices will come down and people will now demand a whole bunch of stuff because they have the cash. How do we know there's more cash than we need? How many, several people have asked about the reverse repo market. And I've been like, I don't know if I want to talk about it. But then I thought about, maybe, I don't know, how it might be interesting to I don't know. I guess I didn't know how to talk about it. But I can give it a shot here. Okay, we'll call this years. 1, 2, 3, 4. Oh no, that's not going to be right. Scale's not right. 1, 2, 5. Yeah, I guess I can do it that way. Undo. All right, let me think about this. 1, 2, 5, 10, 15, 20, and 30. Okay, obviously these are bonds. And this would be the rate or yield. Okay, 1, 2, 3, I suppose, because the 30 year is only at 2 right now. All right. Have you guys run into this kind of stuff, reverse repos? I've been asked a couple of times. One time during non-farm payrolls on Friday. And someone else asked once or twice in these webinars. So I thought I'd try to, okay. All right. Reverse repo. Okay. A repo is a repurchasing agreement. Okay? Where you buy something like a bond for a day, and the next day, the seller of the bond buys it back. So today you get a bond, and they get cash. All right? Now you could reverse this idea. Let's say a bank like the Fed has a bunch of bonds, and somebody wants to buy bonds, but there are no bonds to buy. The Fed owns them all. So they could go to the Fed and say, hey, Fed, I want to buy some of your bonds. Sell your bonds to me, I'll give you cash. Okay? Do you know how much this is happening every day? And this is why you're hearing about it in the media now, if you are. $1 trillion daily right now, which is unusual. $1 trillion a day gets parked at the Fed. Okay? Cash. So the Fed has cash now, but the bonds go to the market. And then at the end of the day, right, the bonds get sold back to the Fed. So it's in and out, in and out, in and out. Okay? Now, why would this happen? People are asking why. What does it mean, Basil? What does it mean, Basil? Okay? Well, typically, okay, you have T-bills. Okay? T-notes. And T-bonds, to use some terminology. T means treasury. This is the government borrowing money from the open market, the bond market. But T-bills are very, very short term. Typically, I think 1 year or less. T-notes are 2 to 10. And then T-bonds are more than 10 years. Okay? Bills, notes, bonds. Now, those with a ton of cash don't want to sit on cash because cash basically pays zero. Think of it as money in your bank account. Why would you leave $1 billion in your bank account earning zero? But you want to stay liquid for whatever, right? For whatever reason. Okay? You want to stay liquid, but you want to earn a return, at least to protect yourself from inflation. So there's a thing called the money market. How does the money market, if you invest into the money market, how does the money market make money? Does anyone have a guess? Yeah, interest, but how? How do they get the interest? How does the money market make money and stay unbelievably liquid? Andrew makes a good guess, but no. They buy T-bills. No, these are not banks. And if you loan somebody money, you're no longer liquid. The money market is liquid. So really, they're looking at lending out money very, 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 very short term. Not a year, but maybe a day, maybe a couple of days. Okay? And these T-bills expire. So if it's a 3-month T-bill, or a 1-year T-bill, at some point they expire. So you could buy a T-bill that expires in 5 days, and 5 days later it goes back to cash, but you earned a penny on your $1,000, right? But you earned something more than what your bank is paying you. What's the problem right now? Why is there $1 trillion a day going to the Fed to buy Fed T-bills and then get repurchased at the end of the day, and then the next day another trillion to the Fed? Why do people keep borrowing, they're borrowing the treasuries from the Fed. They're literally, the Fed's balance sheet, they're giving cash to borrow the money from borrow the treasuries on the balance sheet at the Fed. That's what this is. So they borrow from the Fed, but agree to repurchase them. Well, the issue is the U.S. government, in response to the unbelievably low interest rates that the Fed has created, has stopped borrowing here. They're not doing 3 months, 4 months. In fact, very, very soon, I think in the next couple of weeks, they're going to announce how much they're going to cut. They've already cut their issuance. Remember, when they issue a treasury, they're borrowing. So they've already cut back, but they're announcing again another cut in issuance, meaning they are no longer they're going to borrow less and less T-bills and move more into T-notes and even T-bonds. Because, dude, they can borrow money for 1.2% over a 10-year period. Oh my God, that is cheap. So they're like, well, why the hell would we borrow for 3 months when we could borrow the cheap money for 10 years, for crying out loud? So the Fed's going to the government, the Treasury is going to announce less and less issuance of T-bills and more of T-notes. So 2 years, 5 years, 10 years, and T-bonds, 15 and 30s. So right now, the government can borrow money from you, the market, for 30 years and pay you 1.88% for 30 years. So why would they do a similar deal for 30 days? They're like, screw that, for 30 days, we want cheap money for as long as possible. So all of a sudden, there's no T-bills, but the money market needs T-bills. Why do they need T-bills? Because the money market has promised to keep investors liquid. And the only way they can do that is borrow for like a day or two or three or four, usually buying T-bills that are floating around the world. But right now, there's no T-bills. And there's huge demand for the money market because there's so much cash. And the way to defend against risk is liquidity. So there's so much money in the world that the money market is drowning in money to the point where there's not enough T-bills. And so demand for T-bills are super high, but at the same time, the government's like, hey, why would we want cheap money for 3 months? Give us cheap money for 30 years or 15 years or 10 years or 5 years or 2 years, but they don't want cheap money for 30 days. So now the government's cutting back the supply of T-bills. At the same time, demand is skyrocketing for T-bills. You see the problem? And so that's what this reverse repo is going on, where the money market is borrowing overnight the T-bills that are sitting at the Fed. And this is a sort of a double problem where the Fed dropped lower interest rates to increase demand, but then the government, the fiscal government, came in and they're borrowing money at the long end of the yield curve, creating a supply shortage for T-bills. And this is why you'll see, or you're seeing now or reading, about $1 trillion a day of reverse repos. And if you weren't sure what that means, now you may have another better understanding to say, oh, well, that means there's too much cash in the world. And because interest rates are so low, there's not enough supply of T-bills. And this is somewhat created by both ends of the government. The central bank has been buying $120 billion worth of treasuries. Well, that's not true. 80 billion, because 40 billion is the mortgage-backed securities. So let's say 80 billion a month, okay, is a lot. And that they're part of the problem because they're buying T-bills too. Okay, if you took my macroeconomics course, that's called the crowding out effect. And now there's not enough T-bills for the money market, and the money market needs T-bills because there's too much cash. Why is there too much cash? Well, the other branch of the government gave everybody cash. And it's sitting at a bank, but the bank doesn't want the cash, so it's put into a money market. Now the money market needs T-bills, but there's not enough T-bills. So, right, it's the fiscal stimulus of free money to everybody. Increase the money market, increase demand for T-bills, but then the government says to pay for all of this, they're going to issue more 10, 15, and 20-year bonds, which kind of screws up the money market. So the government's good intention is give everybody money for free. That'll fix things. The unintended consequence is now there's no T-bills because borrowing has gone up on the long end of the yield curve. Cool. Was that helpful? I didn't know how to explain it in a way that it was, I don't know, interesting. So that was my best shot. And I'm sticking to it. Was that all right? Would you click the like button maybe? That's right. Raymond Capital? Yeah, that's right. And repos are typically daily. Well, Jimbo says the banks are now limiting withdrawals and saving. No, it's the other way around. The banks have too much cash. So think of a bank balance sheet. Okay. Okay. You have liabilities and you have assets. And right now there's a ton of cash. Okay. So now there's cash here. And we balance. Well, the bank doesn't want cash. They don't make money on cash. In fact, they're losing money on cash because they're paying interest. So what do they want to do with the cash? They want to convert this cash into loans. Okay? But because there's so much cash, everyone has cash in the bank. Nobody needs a loan. So loans are down, cash is up, and that puts a strain on profits. So your bank actually wants you to have less cash. Okay? So they might convert this because they owe you, right? You might come into the bank tomorrow and say, give me some money. So then what they do is they put more into the money market. And if you come in tomorrow and ask to withdraw $1,000, they just need to adjust their cash balance overnight and say, okay, we'll give you $1,000, and they'll make up the difference every night. You see that at the end of the night, they're like, how much cash should we have over here? They want almost no cash. But if you come in and ask for $1,000, they have to give you that. Now they have $1,000 less cash. So this needs to be liquid to say, all right, well, we'll take $1,000 out of the money market. And then someone comes in the next day and puts in $500 in deposits. So now there's too much cash. So you want to go back to the money market, right? But it's the money market that's doing the demand for the T-bills. Okay? But it's because of the banks. Do you understand that? There's too much money in the bank and nobody needs a loan because the government screwed everything up. Why do you need a loan when everybody's got money? Okay? Then I say when everybody. A lot of people get upset about this. Well, there's everybody. Okay? If you have a good credit score, okay, then your cash is up. Your income is up. Your stock market portfolio, because you have a retirement account, is up. Okay? And your house, you own a home. So you're getting richer and richer and richer and richer. And therefore, you have a good credit score. And everything the Fed's doing and everything the government's doing is to try to influence all these things going up. And if you don't have a good credit score, it's because you don't have any cash in the bank, you don't make much money, or any money at all, you don't have a real job, and you don't have a retirement account, so you don't have a stock market portfolio, and you rent. Therefore, you have bad credit. And you're not getting rich on the free money from the government. And you're really missing out. So I would do whatever it takes to stop being poor. You're missing out. You're like, well, Wayne, it'll take me 10 years to fix my credit score. Uh-huh. Get going. I'd have to work really hard, maintain a job, pay my bills on time, have more cash than debt. Yeah, that's right. You might as well put all your money into your Forex account and grow it. Yeah. Stay poor. Sell your TV. Anyways, let's move on. All right. Mohammed said, hey, man, I missed the beginning. I just explained the reverse repo market and why it's doing what it's doing. All right, so here we are, Aussie dollar. And I would like Aussie dollar to go to 75. Okay? Maybe 80, but it's too early to say 80. We're at 73.5. Am I going to buy it? No, not yet. I think it's a bit early. It's only the second week of August. So I'm getting there. I'm interested. So I want to watch things like Australian exports to China. Do I still have trading economics up? China exports. How about China imports? So how do I do this? Where am I? China imports. Let's go China. I'm guessing it's imports. Let's just type it in. Come on. Yes! Good. All right, let's check this out. Imports to China increased 28% year over year. Whatever. It doesn't matter because last year sucked. The 10th straight month of expansion in inbound shipments. Cool. Refined products, nat gas, copper, steel products. Does that say 650%? Does coal say 170%? Less energy. Guess what? Remember, this information was reported at the end of Friday? What do you think's happening to WTI based on this information? Okay? Do you see it gap down? Do you see it falling Friday? Falling Friday, gap down? Why? China's importing 20% less oil? Do you think that matters? Should you be paying attention to this? Are you trading energy? Do you want to trade energy? If you were trading energy, do you want to pay attention to this data? Yeah, maybe. I don't know. Okay? Imports rose from the US 25%. And Australia 41%. Oh my God. Oh my God. Oh my God. Oh my God. Oh. Maybe this is your opportunity to get your Australia on. Is this your Aussie play, guys? So we get back to this, and I'm like, yeah, maybe. Does it have to be now? No, but that could be enough. I could tell somebody, I'm like, hey, I was just looking at the import-export data out of China, and I saw there was a 41% increase in imports from Australia. I think maybe we need to start tiptoeing into some Aussie dollar. Follow that money. Because there's a 650% increase in steel products and a 160% increase in demand for clean coal from Australia. Oh my God. And now you sound smart as well as look beautiful. How many people are doing this type of research? This is what you should have done this weekend. Okay. Some, but not enough. Thank you for the honesty, by the way, because you are talking to your subconscious. Okay? Mohammed says, I'm long already. I don't care if you're long or short. The issue is, do you know why you're long? Oh, well, blah, 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 blah. No, most likely you'll say, oh, well, it's turning, or oh, it's a support, or oh, something else. But very rarely will somebody say, oh, I'm tracking the flow of money globally and using a chart on a 15-minute, right? Text on a 15-minute chart. Okay? See, I think the thesis is I think more important. I'd rather you say you're tracking this money and that you're only looking for opportunities one way or the other. You either want to be long Aussie or you want to be short US dollar this way. Now, if you've decided to be short US dollar, you're just going through every pair asking yourself, should you short dollar versus Kiwi? Should you short dollar versus Aussie? Should you short dollar blah, 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 all the way through the G8 or G10. But maybe you've decided, well, you want to buy Aussie dollar because of export data to China. Exports to China are up, so you want to play the Aussie dollar increase in valuation. So now you're like, should you buy the Aussie versus dollar? Should you buy the Aussie versus yen? Should you buy the Aussie versus everything? And so you can get yourself here and maybe set it up this way. Okay? And say, should you sell pound Aussie now? Should you buy Aussie Kiwi now? Should you buy Aussie Swiss franc now? Should you buy Aussie US dollar now? Should you buy okay, we need obviously an Aussie yen here. Okay. Should you buy the Aussie yen here? Okay. Huh? What do you think of this? Is this a decent setup? If not now, when? Okay. Right now, this is Aussie versus yen. I can tell you based on seasonality, JPY is usually stronger than weaker. I'm not saying it's going to be strong, but what I'm saying is typically it's less weak. Mohammed says, hey, are central banks going to influence the exchange rate, intervene? No. Okay. Six months in Forex.Today, I learned more about money than in my whole life. Thanks for the value, Wayne. Hey, my pleasure. Stanislaus says, hey, how do you develop a sense of what's going to happen? Like growth. You read about import and China and the understanding the Aussie will play. That's called fundamental analysis. So you can join FX Bootcamp, pay $500, and you'll learn all that kind of stuff. Or you could pay, I don't know, $100,000 and go to Harvard like I did and get a macroeconomics degree. So You got the 4-year $100,000 plan, or you could pay $500 and learn it in 100 hours. Your call, my friend. Your call. So KG's like, all right, so based on this, he wants to scalp it on a 5 or 15. Okay, cool. The thing is, as long as you know what you're doing, even if you're wrong, it doesn't matter to me. Even if you think you know what you're doing, okay, then you're going to know what your entries, but you'll also know when you're wrong. Okay? Okay? Dan's going to meet on Friday? Yeah, let me say it again. There's going to be a handful of us, very small group, meeting at the Harvard Club at the rooftop bar on Friday. And then after, we'll probably head out into the city, go to a cigar bar and hang out and have a couple more cocktails and just shoot the breeze. You're welcome to attend. Anybody? You going to be there? One of the guys that are probably going to meet up with us is an FX boot camper from many, many years ago. And I was talking to one of the producers at Bloomberg Television. We had just wrapped up a shoot. And then she said, oh, I wanted to talk this is the producer now. She wanted to talk to a retail trader, and I forget what the subject matter was, but trading Forex, what it was like to be a retail trader. And I connected him up with Bloomberg, and Bloomberg Television went to his apartment, or his home, just outside of New York City, and interviewed him, did a profile. Isn't that cool? So I had Bloomberg visit his home and then later put him on TV. How about that? You'll have to ask him that story. Like, hey man, is it true Bloomberg came to your house and interviewed you about being a retail Forex trader? Uh-huh. How neat is that? Hey, Chand, if your indices don't work, you're probably not using the right one. So if you've run the installer recently, okay, you have to run the installer, not manually. If you run the installer, it'll install currency indices or currency indice ECN. And you'll see an ECN that you don't have like Aussie yen, like a regular account. I think it's something like odd or something, right? Versus yen. I'm not a ECN dude. I don't like hard dollars. I like soft dollars. So anyways, so it doesn't work. So we fixed that and coded this from scratch. So now if you go to the ECN one, it will work. Now I don't have an ECN account, so now the ECN doesn't work. So you have to have the right template. Most likely you're trying to install things manually, and I haven't updated the manual files, so you'll have to run the auto installer. Okay. Do I have a tax course? No, but I could. The problem is that it's just globally. We're from so many different places that there wouldn't be a consistent setup for that. All right, cool. So anyways, there's your Aussie play. Let's take a look. Let's start with the indices. Dollar is currently strong. Yen is currently strong. Pound strong. That's good. Change in sentiment at the Bank of England. Europe is weak. That makes sense because the dollar is strong. CAD is strong. That's good. Okay. Aussie sort of in between. Kiwi kind of in between. Yeah, let's do gold and stuff. Yeah, let's do gold. WTI down. We know that and why. I've already covered that. And gold down to our next level of support, which I have marked here, and I did quite some time ago. Okay. So the question is, did you buy it at 17? Because that's what's kind of happened here. The next part of that play is what? The easiest one is the double bottom. The more difficult one, the more difficult one is setting up the higher low, because then I actually need the higher high, higher low. So I can play a double bottom because it's a double bottom. I don't know if I'd catch this because I don't know if it's going to do that. It becomes fib wars. If you've heard that statement before, fib wars. I don't want to get into a fib war. So if it doesn't double bottom, if it instead makes a higher low, then I really need a higher high, higher low after that. Hey, thank you, Joe. Okay. So let's take a look here. I had gold plausibly based on technical analysis. Okay. Bouncing off support. It just went to the next level of support. That's all. Okay. Okay. And that goes way back to here. Okay. So what are you guys going to do? How are you going to play it? Well, I would analyze the US dollar. What have I told you to watch in regards to discerning dollar strength or weakness? What have we been talking about over and over and over the last couple of months? What's our canary in the coal mine? Ooh, that's boomed. Okay. Okay. 1.28. Do you know what it was 4 days ago? 1.2. So I'm hoping, okay, that as the Treasury market falls, let's go 5 days. Look what's happened in 5 days. We were at 1.14. I think it was actually 1.12 was the low. Okay. I mean, I just did a thing where it was 1.125. But now, here we are, it tickled 1.3 on Friday. So hopefully, that means people are coming out of the bond market. Okay. And that the US dollar will weaken. Okay. Amazing, right? Just in that short amount of time. That's a huge move, guys. If you watch the video of trade non-farm payrolls live at FX Street, I give a pretty detailed, like probably 40-minute discussion about it.
But if you want more of that, you can always go to one of these workshops that are they're free.
Strange, I don't know how they organized this. Apparently they organized it as a playlist, but they haven't updated it in a year and a half. That's kind of funny. That's funny. All right, buddy. 1 day ago, Tron, Bitcoin. Look at them doing all that stuff. This looks like me. 184, 3 days ago. This is me. There we go. We call this swap or carry. Now, the interesting thing about being a currency trader is that you can take advantage of this leverage. All right, cool. So if you want to watch that, booyah, then you'll have to go there. Oh, I can't. I'm not logged into the stream, so I can't post it. Maybe I can over here. Here. Say something, I'm giving up on you. All right, cool. I swallowed my pride. Cool. So anyways, often if you think the dollar will fall, you might say gold will appreciate. Think of it. People don't want bonds anymore because the price of bonds are likely to fall. Okay? And if that happens, what would you do with your money? You're like, I don't really want a bond. Besides, they have negative real yields, so why would I want to guarantee losing money? Maybe I want some gold instead. Why would bonds fall? Because inflation expectation going up. And you're like, well, that's another reason to own gold. So anyways, maybe. What I think is important is you make a decision. Okay. Okay. Kind of looks like a pattern to me. Not that complicated, is it? Okay, so I want to see, stabilization in oil, stabilization in gold. We're looking at some major things here, like looking at oil. This is supposed to be the bottom down here, right? So maybe I'm a buyer of crude oil around 60. Why would I think $60 a barrel? Well, that demand would increase. Now, I think you should look at supply here. And I'm not concerned about supply shortages, in fact. I'm concerned about supply increases. That Russia needs to cheat. There are many OPEC countries that want to cheat. And the Americans might start producing more again. I think the risk here is oversupply. That demand is not quite there, and that the suppliers of oil are going to oversupply because they need the money. They're like, yeah, well, we'll probably bring oil all the way back down to 60 or maybe even 50, but at least it's cash, right? They'll get cash flow. Now, they might be less profitable, but sometimes you just want to pay the rent. Okay? And I think that's the risk. That you can see that the Asian countries, right? ASEAN plus China, there's a bit of a slowdown in demand. We see that in the import data. And so this needs to come down. But at what point does price falling eventually then increase, right, demand, which then stabilizes price? Okay, aka equilibrium. So that's sort of the interesting play here. Okay, I'd like to see inventories draw down. So the 25-year average is somewhere in this period. Supply is at the highest. I call it peak supply. And then as some point in the future, right, we draw down supply. And if that's occurring, so this is supply going up, okay, and then peak somewhere in here, and then it'd be interesting if we start doing this again. You can see this is a November play. So it's the middle of August, so you could say, well, in the next 3 months, let's take a look here. Okay. Did I just hang on? Let's take a look. January, February, March. Okay. March, April, May. want to go farther back than that. Okay. So here's June, peak, right? Peak. And then when does it move? Call that October. Okay. June is sort of here. So here. What do you think? Okay, it could be September, it could be October. What do you think? Yeah, Chand, there is a video tutorial, right? It's in on the site. Yeah, there is. There totally is. Raymond says, hey, do you think crypto is taking place as a hedge of uncertain times? It's not a hedge, it's just an uncorrelation. So many managers are trying to construct portfolios that simply don't buy a bunch of stuff based on one thing. Meaning, if you buy gold, oil, and right, and S&P 500, and sell the US dollar, you face one risk. Because if you get this right, they will all work because of one macro scenario. If the macro scenario doesn't work out, meaning you can be completely wrong or somewhat wrong, right? That's the risk. You're either partially wrong or totally wrong, then your whole portfolio comes down. So it's not a hedge, that's called correlation. So someone might own Bitcoin simply because it may go up while other things are going down, and that would offset losses in other markets. So they would treat it just sort of as an independent variable inside the construction of their portfolio. Okay. Yeah. All right, I'm going to call it a day. I will see you tomorrow. Thank you for being part of the Forex.Today YouTube community. Thank you for being a client of tradersway.com. Thank you for being a member of FX Bootcamp. Thank you for the hard work. Thank you for clicking like. Thank you for leaving comments. Thank you for all your positive energy. I will see you tomorrow. Have a wonderful day. Peace on earth. May the pips be with you.